You're looking at software companies, probably the most heavily shorted stocks right now, and you're seeing heavily shorted names absolutely surge, especially after earnings. A good trend if you want to be a trader. I don't know if you saw what's going on with Kohl's today. Reported, you could say solid numbers. They were expecting growth to decline 6 to 7% or 7 to 8%. Now it's going to decline just 6%. I think they had earnings where you could drive a truck through it from like 0 to 60 cents, and now they're saying it's like 65 cents to 80 cents or something like that. Either way, it was a good report for Kohl's. Kohl's hasn't been doing well. A lot of value there. They own a lot of their stores. 32% of that stock, the float is short. What do you think the stock is doing right now in that report? It's up 25% today alone. We saw the same thing happen with TerraWolf. 32% of the float is shorted. And that was just for Google announced a mega deal with the company to backstop $1.8 billion of its lease obligations. And that included 8% stake in the company, filled with warrants and things like that. But the stock went from 5 to 9 in a day. Imagine you're short that stock on that kind of news. I remember David Einhorn pitched Keurig as a short just by some whistleblowers that he was talking about, which I found kind of funny. But these whistleblowers were grundled employees that were pissed off. I mean, you got to be careful with that stuff. And I would tell you, never ever short a stock that has a great product that everybody loves. It's that simple. You can short a stock with bullshit if it has crazy financing or whatever. You think demand's going to... Whenever they have a good product that people love, and Corey, they're everywhere. And I remember David Einhorn pitching that, and I was in the audience at the Value Investing Congress when he did, and the stock fell. I'm like, he's crazy. I mean, I just don't see... David Einhorn is one of the best analysts out there. He really is incredible. And he didn't provide that evidence for me to be like, holy shit, he's right. And I've seen him. I've seen him with short sales. I've seen Ackman with short sales, and some of, their research that they do, those two guys are incredible, but it didn't hold water with me. There wasn't enough there. And sure enough, I think it was Coca-Cola signed a deal with Keurig, and I think it was Coca-Cola. It might have been somebody else, but the stock, and you get wrecked, right? So shorting is, holy cow, if you're going to short stocks, good luck. I mean, you have unlimited downside, right? I mean, just the stock can go up forever and ever. I mean, you put money into a stock, you're only going to lose the money you put in, but when you're shorting, the upside as it goes higher and higher, you're going to get wrecked. And my point here is there's a few points. One is the Fed on Friday just created a risk-on market, which is a lot different from the previous 2 weeks because it's been risk-on. Daniel, I've been telling you buy. Stocks have been hitting all-time highs like crazy. And then all of a sudden we got weak jobs data that was revised significantly lower. We had higher expected inflation in the PPI and the CPI. I mean, CPI, 3.1% in the core. PPI was a joke. And what was that? The largest increase that we've seen since, 3-4 years? And that led to what? We talked about it because stocks initially rose on that news. And Daniel and I said, listen, I didn't think those reports were great at all. It was a couple weeks ago. What happened? The market started selling off, especially the risk-on assets. We saw crypto sell off a little bit, meme stocks sell off. Then we saw AI-related names, the biggest technology companies, those leading the charge in that bull market. They started selling off the past 2 weeks. And if you watch CNBC, you thought it was the end of the freaking world. It's the end of the world. That's it. We're done. After 2 weeks, 3% pullback. That's all you needed, right? Doesn't matter if you're up like 25% annually the past 2 years. Doesn't matter. 3% pullback. We told you. All the bears come out. We told you so. We told you to be careful. You told us to be careful 50% ago, okay? When NVIDIA was like $40, now it's 200. It's going to push 200 after today. Probably after they report earnings. We'll get to that in a minute. But when Powell came on and flipped the script like that, it was very surprising. It was so surprising you saw the reaction of the markets, not just to me, but there were analysts that said, hey, you know what? I think the Fed should cut rates now. They should definitely cut the rates. And I just didn't think that. I thought the Fed and Powell had much more justification February, March, April, May, earlier on when you saw inflation crashing. And now you're seeing inflation going back up, whether you think it's one time for tariffs or whatever. But he's been saying that. It's probably going to go up because of tariffs. You get it. And now all of a sudden you pivot and say, hey, you know what? Maybe it's because of unemployment, but that pivot from going hawkish to dovish is huge because we're under the impression where we're going to see stagflation, which is higher inflation and, stagnant demand, which is, again, it's a negative and it's not like a recession. It has this negative connotation to it, but it's actually not so bad for asset prices as long as demand is okay, which we're seeing on GDP. But when you see and you hear the word stagflation, it creates uncertainty in the jobs growth and productivity, overall growth in the U.S. economy. But when you look at pivot, and Powell's pivot and how it's a game changer, now you have lower rates, which is going to fuel more borrowing for business and consumers. It's going to create huge demand for housing. And people might say, well, Frank, the long rates are still high right now. And you're right. The long rates haven't really come down on this Fed. Everyone's expected Fed funds short-term rates. But there's literally trillions and trillions of dollars of equity in these homes that have gone up tremendously in price, that are at all-time highs, these prices, and people can't tap them because they don't want to pay such a high refinance rate or HELOC. Well, if you're seeing those rates come down, the HELOCs or refinance, they're tied to the Fed funds rate. So now you're going to allow a lot of people to take equity out of their homes, which is a lot of equity. People took all the equity out of their homes before the credit crisis. You were allowed to do that. You didn't put anything down. That's why there was a housing crisis. So people just left. They said, I'm not freaking, if you put down 20% like you're supposed to on a house, you're not going to leave. If it goes down 10%, you're going to lose all that money. If you put nothing down, you walk away. You don't care. But now you're looking at it and you look at this big picture. What does it mean? It means that what Powell did was very surprising, but it's a great thing for anyone who owns assets, including homes, cars, collectibles, especially stocks. Because now you're lumping deregulation from banks where hundreds of billions of dollars are going to flow into the pockets of businesses and consumers over the next few years. Why are they lowering this? Because the Fed's going to bail you out the banks anyway, so why keep the capital there? Let's keep the economy going. No matter who's the president of the United States or what administration's in, get rid of those regulations because the Fed's going to backstop freaking everything, which sucks and you hate it, but it's real. You better not be shorting a stock that has a very high short ratio. And I have a list here that I'm going to share if you're on the YouTube channel. They have a bunch of stocks here. Some of them are down. The most heavily shorted stocks are down. Some of them are down. They may have like 30 here, maybe 40. But if you look at some of these with high short ratios, CA Industries, $22 stock, it's 88% float shorted. Holy shit. I don't know what's going on there. Warrants, I don't even know. It's up 179%. You look at Zenus Biopharma at $16 stock, short ratio of 52%, it's up 107% this year. Now you have some that are down. RE Alpha Tech is down 87%. You have So Good, SOW Good, SOWG is a symbol, it's down 67% this year. But asset entities, this looks like a shell company that was created to buy probably Ethereum or something. It has a 46% of the float is shorted. It's up 1,100% this year. Again, a few of these are down, but I'm looking at this list with Hims and Hers, 34% short ratio. It's up 88%, has come off its highs. Sleep Numbers in there, Kohl's in there, right? We just talked about. TeraWolf was in here. Plug Power. There's a lot of stocks that are in here that you could, Lucid Group, Nano Nuclear Technology, 30% short ratio is up 30%. If you own one of these and these stocks just report decent news, look out. Look out. You're going to see the stock absolutely go through the roof. That's why you're seeing guys like Chanos and you see Citron say, hey, you know what? We're not going to short stocks anymore because it's really hard, especially when you have so much power from the retail audience where if they get on board one of these stocks, no matter what it is, like the GameStops or the AMCs, and they just come out with this campaign that goes viral on a Reddit or Discord channels and these guys start buying, look out. You're going to get wrecked. These guys before, it's even bigger now, but we're talking about what? Probably 5 years ago now, 4 years ago with GameStop, where you're looking at retail basically put Melvin Capital, a multi-billion-dollar firm, out of business. And they would have went out of business, but they needed a cash injection, and they got the cash injection. These are really smart people. They got wrecked. If you think it is short in this market, a bet against the market, be careful. Will everything come down? Yeah, you could buy inverse ETFs for the S&P 500, the NASDAQ to protect yourself. That's fine. But outright shorting, guys, it's a big boy's game. Just like options is a big boy game. A lot of people lose money in options. I feel like it's like gambling. If you look at gambling, the gambling sites right now and how many prop bets they have, how they're in the middle of the game, the announcers are like, hey, right now, LeBron James is third quarter. What do you got? 12 points and 3 rebounds for the third quarter. They're forcing you to bet. I could say that I've gambled for a lot. I like gambling. I don't gamble too much. I gamble for fun. I don't gamble to actually, win a ton of money. I just like to gamble sometimes. Put a little bit of money on a game here. I gamble with the horses and stuff like that. I've known hundreds, if not over 1,000 people growing up, and I don't know anyone that's won in gambling. A lot of people don't. I won in gambling from horse racing. I've done very, very well in. But just betting sports, no, I lost. I didn't get crushed or anything, but most people lose because you like a game and you bet it and you win, and that's the 1 o'clock game. What are you doing at the 4 o'clock game? You got to double down. Right? So, when it comes to this shorting game, be careful. A lot of people are just, these daily options and one-day options and craziness and stuff like that. Just be very careful. We're not in it for that. That's not what this podcast is about, these quick hits and, trading. Probably over my 30-year career, I've seen 50,000 videos of the best traders and just, this is what you need to do to trade. Really? Buy here, sell here. Trade. You don't have to know anything about the stock. And now AI does all this shit for you and everything. I've seen so many of those come and go. There's only 2 or 3 traders I actually trust, that I actually follow. Jeff Clark was one of them when I worked at Stansberry. He was great. He was great. He was so great that his picks were getting picked up by the major media services like Bloomberg and Capital IQ and flyonthewall.com and briefing.com. They would say huge action, put action activity, or call action activity. And it would cite his newsletter. And it was so big that the algorithms started picking him off because sometimes you don't have a lot of volume in this. And he had losers because he'd have stops on these positions. And right away, I mean, you could see all the trades because you're talking to retail investors and they all put the trades in the market. And, he's getting whipsawed out of there. But what's his name? Colin Worth, I believe. He's great on CNBC. I love him too. There's very few. Dan Fitzpatrick was another trader I really respected back in the day. I'd love to get him back on the podcast. I haven't seen him in a long time. He was great. If you guys just been listening to this for the past 10 years, this was street.com when he used to have, what a personality. Holy cow, that guy's crazy. He says anything. He was so funny. He was funny. People loved him. He was awesome. Good friend too. I tried to get him on a couple times. Didn't work. This is probably 7-8 years ago. Maybe I'll look out to get him on and see what he's doing. Stockmarketmentor.com was his site. Very good. Didn't recommend stock picks. Just taught people how to trade, but he was very good. But when it comes to trading, just be careful. We're not talking about that. But if you're shorting stocks, listen, it's a different environment than it was 10 years ago, 15 years ago, even 5 years ago, where, shorting is like a losing man's game. It's very difficult. You hedge, be careful. I know you have, Chanos does a lot more than what he's just telling you when he's just shorting a stock. There's other things that he's doing to protect his downside, but it's pretty crazy. It is crazy. And when you're looking at that list of the most heavily shorted stocks, be careful.